$14 billion.
That's how much money is sitting trapped right now inside private credit funds. Investors asked for it back. The funds said, not yet.
Not yet, as in, that's the whole answer? And this is happening inside a market that's somewhere between $1.8 and $3 trillion, depending who's counting.
Blackstone, Blue Owl, Apollo, BlackRock. 6 of the biggest names in the business have all told investors in the last few months, you can't have all of it back right now.
From Trek for Wealth, this is the podcast. I'm Avery.
I'm Grant, and today, the loan market nobody outside of Wall Street had heard of 2 years ago, and why it might already be inside your pension and soon your 401k.
Before the panic, what is this actually? Private credit. It sounds like a euphemism.
It kind of is one. A company borrows money from someone who is not a bank, a private fund instead. No public market, no ticker, no daily price. You lend, you wait, you collect interest.
And that's bad?
Not inherently. It just means nobody can see inside it easily. And when a few $1 trillion sits somewhere nobody can see inside it easily, that tends to be the part of the story that matters.
Let's get into it.
Here's the thing. This didn't sneak into existence. Congress built the doorway for it on purpose in 1980. The Small Business Investment Incentive Act. Jimmy Carter signed it. Small and mid-sized businesses couldn't get capital after the 70s recessions. Banks weren't interested. So Congress created something called a Business Development Company, a BDC, a fund that could raise money from the public and lend it straight to the businesses banks wouldn't touch.
So it started as a help the little guy law.
It did. But that same decade, something almost identical was happening one floor up on Wall Street for a very different kind of borrower.
Here we go.
1969. A young bond trader named Michael Milken is at Wharton, and he notices something everyone else is ignoring. Lower-rated corporate bonds, the ones investors called junk, are paying way more interest than their actual default risk justifies. Everyone else sees garbage. Milken sees a mispricing.
So he buys the garbage.
He builds an entire market around the garbage. 1977, Drexel's first junk bond deal. $30 million, an oil and gas company. By the early 80s, he's moved the operation to Los Angeles, in the office at 4:30 in the morning, single-handedly financing the leveraged buyout boom of the whole decade. 1986 is the most profitable year junk bonds ever had. In '87, he's personally paid $550 million.
In 1 year.
In 1 year. And then, December of '88, charged with securities fraud. Drexel settles for $650 million. Milken leaves the firm in '89. Here's the part people forget. The junk bond market didn't just have a bad quarter after that.
It fell apart.
Almost overnight. Because the entire thing had been held together personally by one guy's relationships with buyers and issuers. February 13, 1990. Drexel Burnham Lambert defaults on $100 million in short-term loans. Files for bankruptcy that same evening.
So the market that promised everyone outsized returns outside the regular banking system collapsed the moment the one person holding it together walked away. That's the 1990 version.
Sounds familiar.
Now fast forward. 2008. Global financial crisis. Regulators respond with Basel III, Dodd-Frank, much stricter capital rules for banks. Banks, very predictably, pull back from lending to exactly the mid-sized, higher-risk companies they used to serve. Banks' share of private lending in this country falls from 60% in 1970 to 35% today.
So the room empties out again, and private credit funds, the direct descendants of those 1980 BDCs, walk right in and take the business. From under $400 billion before 2008, to somewhere between $2 and $3 trillion today.
So what's the actual thread connecting all three of these?
The history of private credit is really the history of a room emptying out. Banks leave because regulators made it too expensive for them to stay, and someone else always walks back in to make the loan anyway. This is the second time in 50 years that someone else has been called a genius on the way up.
And we already know what usually happens on the way down.
We're watching it happen right now.
Okay, let's get into what's actually happening this year.
Late 2025. Two high-profile borrowers, First Brands and the auto lender Tricolor, collapse into bankruptcy. That's the spark. Since then, it's been one gate after another. Blue Owl, February 19th, tells investors it will no longer honor requests for a set amount of money back. BlackRock's H-Lend fund, $26 billion, restricts withdrawals for the first time ever, after investors tried to pull out $1.2 billion in a single quarter, and the fund had only raised $840 million in new money to cover it.
So more people wanted out than were putting money in.
Morgan Stanley caps redemptions to about half of what was requested. Cliffwater, a $33 billion fund, caps investors to 7% when 14% asked to leave. And in March, Apollo, one of the largest names in the entire industry, tells investors they can have 45% of what they asked for back. The sixth major manager that year to do it.
And who exactly is on the other side of that gate? Who's the one that can't get their money?
CalPERS, the single largest public pension fund in America. Caught in the Blue Owl gating event alongside pension systems in Ontario and British Columbia.
So it's not just some hedge fund guy's bad bet. It's teachers, firefighters, retirees who did everything right.
And here's the number underneath all of it. Fitch Ratings' true default rate for private credit, the one that counts loans quietly restructured instead of just outright missed payments, 5.8% for the 12 months through January, the highest they've ever recorded. Morgan Stanley has warned it could spike toward 8. UBS put out a worst-case scenario of 15.
That's a huge range to be uncertain about. And here's part of why nobody agrees. 60% of those defaults aren't missed payments at all. They're loans converted to something called PIK, payment in kind, where instead of paying cash interest, the borrower just adds the unpaid interest onto the loan balance and keeps kicking it down the road. It's gone from 5% of the market in 2022 to 11% by the end of last year.
So the company doesn't pay you back. It just promises to pay you back more later.
Right. And meanwhile, the industry is asking regulators for something else entirely: access to your 401k. In August of last year, the president signed an executive order directing the Department of Labor to open the door for private credit and private equity inside retirement plans. This March, the DOL proposed the actual rule, with safe harbor protections for employers who add it. Some plan providers, like Empower, are already partnering with firms like Apollo to offer it.
So the same asset class that's currently gating pension funds is being teed up for retirement accounts. Right now.
Right now.
Okay, Steelman it for me. Is there an actual case for this stuff?
There genuinely is, and this part matters. It's not a scam. Private credit has, historically, offered higher yield and lower volatility than public high-yield bonds because you're being paid a premium for accepting illiquidity. For an institution with a 50-year time horizon, that trade can make real sense. Diversification, steady income, a hedge that doesn't move in lockstep with the stock market. The industry's own language is that the illiquidity is a feature, not a flaw.
But the premium only works if you can actually afford to be illiquid.
Exactly. Institutions with decades to wait can absorb a gate. A retiree who needs grocery money next month cannot.
Which is exactly who this is now being marketed to. The Financial Stability Board flagged it in May. As more regular people get access, the risk isn't just that some of them lose money. It's that a wave of retail investors all wanting out at once in a fund that was never built for daily liquidity is precisely the kind of stress that turns a slow leak into a run.
Okay, so what do we actually do with all of this?
5 moves. Number 1. If your 401k or an advisor ever offers you a private credit or alternative income fund, the first question is never the yield. It's the liquidity terms. Ask directly, what's the redemption window and what happens to my money in a stress event? If they can't answer clearly, that's your answer.
Number 2, treat any private credit allocation like a single stock, not a bond fund. Cap it at a small slice of your overall portfolio. Never assume you can get it back on demand, because right now, plenty of very sophisticated institutions can't.
Number 3, match your money to your timeline. If you need those dollars in the next 5 years, illiquid credit is the wrong bucket. Full stop. This is money for the part of your life you're not touching for a long time.
Number 4, if you ever see a fund's fact sheet, look for the word PIK. A rising share of payment in kind interest is often the fund quietly telling you its borrowers can't pay cash. Read it as a warning label, not a footnote.
And number 5, don't panic if you're already exposed through a pension or an index fund somewhere. But do ask your plan administrator directly what percentage of your retirement assets are illiquid or private, and whether a gate provision exists. Know it before you need to know it.
So the money didn't disappear, it's just waiting behind a gate. And nobody agreed, in advance, who gets to open it first.
1980 gave small businesses a doorway banks had closed on them. 1990 showed us what happens when an entire market is held together by one person's confidence. 2008 pushed the banks out of the room again. And today, the room is bigger than it has ever been. Trillions of dollars, pension funds, and soon, ordinary retirement accounts, all standing on the same illiquid floor. None of that means walk away from every yield that isn't a savings account. It means understand exactly what you're being paid for and exactly what you're giving up to get it. Preparing without predicting. Always.
That's Trek for Wealth. Keep trekking.